Hey guys, it's Will here. I'm going to go through the markets as usual. If you've been watching my videos, you know that I've been negative on the markets for technical reasons, technical analysis. So hopefully you are on board with using the charts to kind of see what's happening and not just buying and hoping and buying dips for no reason, without any specific strategy. I'm using TC2000 here. If you want to get a free trial or $25 off, you can check out the link in the description below. I've got the gold plan, and I use real-time, US real-time data as well. If you're not familiar with these charts, I'll talk a little bit about that, but you can check out my other videos. But up here I have, moving averages, and there's like the 3 moving average, the 8, 21, EMA, exponential, this 50-day, 20. There's also volatility stops, so the red and the green. So green, the price is above that. It's usually a good sign. That's just the average true range, like based on the ups and downs of the stock, the volatility. And when the dots turn from red to green, you've got an uptrend. It's generally a good, indication of an uptrend. It also can be used as a stop loss. The other one that I use is the price percent oscillator, or MACD. It's basically the momentum. So when you see an uptrend, you have this line here, the price percent oscillator above the moving average, the blue line. When it crosses down, that's a trend. Usually a downtrend. So you can see how that correlates to this. There's also the zero line. So when it's above zero, it's usually stronger. Even if there's an uptrend, but it's below zero, it's up to you, but that's generally a weaker, period of time. There's other indicators here, but that is the gist of it. So anyways, with the Russell 2000, first of all, I mentioned that we had this consolidation period, like a really flat wedge, or, a flat spot. We kind of broke out of it. I had a big bump, and then it just completely tanked. And so you see the red dots, you see it break down below the 8 exponential moving average. But essentially, if you drew a line with an uptrend, you would break that uptrend. So that you can use the 8 EMA as sort of an uptrend line. And once you break down below that, that's definitely a sign. But you have this MACD or PPO cross right here. And so, I was very hesitant to be making purchases of this up here. Let's see. If we look at the NASDAQ, it's generally been in a good state. But I mentioned, if you watch my videos, when this got flat along the PPO was like flat. It hasn't quite crossed, but it was pretty much touching and flat. And there was a bit of a pullback here. I wasn't too keen on it. And then, of course, we get this big candle here. This is a bearish engulfing, so this engulfs the previous candle, but also the one before it. And there's a wick here, like almost like a shooting star thing. It started here, went up, and then it pushed right down. So this was a complete reversal right here. And even if you get like the next day or two, you get a little bit of a bump, people will be, oh, we're back to normal again. But this is a signal, like, it's a signal that something changed in the sentiment. It doesn't always happen. You can see here, it starts to curve and go down. So one thing I like to do, I look at this momentum here, and I don't want to buy on these downward momentums, even if there's like a green candle. See this little spot right here? We have a couple green candles. We're back up above the 50. But down in the momentum, you can see it's flat, and then it keeps coming down. So I don't like to just jump right back in as soon as you see a couple of up days. What you want to see is, if you're using the trends, uptrends and downtrends, you want to see a higher low established once you cross a downtrend. So like, say for example, you've got this downtrend here. You break it right here. Some people will buy right at that point, but it often pulls back, and then you start to go up again, and that's when you establish this higher low. So if I put a little flat line here, just to show you, and then we have this line down here at the bottom, you've started to establish So if I hold the shift down, I can make the line straight, horizontal. So I can see that I've now established a higher low. So once you have this scenario where you, either here or this one is where you've established that trend. So just you don't necessarily buy at the break of the first break of the downtrend, okay? So right now, we had a high, then another high, and now we've come up and back down again. So now we've established a lower high. Oops, if we put a line just to show you horizontal, short little horizontal line, we've now established a lower high, and there's a bunch of things here. We're down below the 8 EMA, like the 8 exponential, but this momentum now you can see it's curling down here. So you don't know, like it might go to the 50, it might go down to the 200, it might not even go down to any of those. There's other support scenarios based on previous price, but this is not looking good. And the other thing, if you've noticed on the channels, the business channels, there's a huge volatility. Like it'll go up one day, down the next day, or it'll go up and then it'll come right back down. These things here show like that it started up here, went up, and then it went back down like that. The Dow Jones is a better example. Yesterday, it was actually up from the previous day, was up, hundreds of points, and then completely reversed. And the thing is, it's not a mystery. Like if you're looking at a couple of things, if you look at this downtrend from when this started, so we have a higher low, we have a lower high here, we have the high here, and then we have this one. But if I draw a line like that, now we're even going steeper. So now we're accelerating, and so that'll reach a point where it's too much, and there'll be reversals. But you can see, like when you get this bounce here, it doesn't sustain itself, because now you've got damage in the chart, technical damage. So you've got previous resistance, like people wait for it to come up a bit, they sell, or you've got this 50-day moving average. So now we're below the 200 and the 50. So it becomes a damaged situation. Whereas when you're up here, you've got highs, you've never had a previous resistance. Like when you're above this area, there's nothing before that which will affect everyone's up, making money. And so when you, in this particular case, it failed the first time, but the second time it broke through the 50. So you don't know for sure what, if that's going to break. But down here, you can see you haven't crossed over the MACD or the price percent oscillator, and you're also below zero. So this particular situation, you could say, I'm not going to buy when the MACD is below zero, or it hasn't crossed over yet. So you might wait and see this one, and you might not even want to buy right here because it's right below the 50. So you might buy here when it's like crossed up above the 50. So you have to kind of decide what you want to do for your criteria. S&P 500, you can see here again, I put an arrow, but you broke this downtrend, and see you come up and then you pull back and then you go up again. So this is the entry point once you establish that new higher low. And then of course, if you're using these volatility stops, these green, it would have triggered here, potentially not. If you didn't sell, like if it doesn't close below the dot, you might not have sold until this spot, the one right here. If you're waiting for the end of the day, this would have been a sell point. But now we have this downtrend here in the S&P, and we're below the 50-day now. And you can see that this momentum is curling down in a more aggressive manner. But like I said, as it gets below, quite a bit below, and starts to go vertical, like downward vertical, it's a point when things will reverse itself at some point. And you don't know how long that'll last for. But another thing that I use potentially sometimes is the stochastic. So it's none of these indicators are guaranteed or anything, but when you get down into the low ends here, below 20 or even lower, like this particular case, we were right down here. It doesn't mean that you can buy the dip, but it is a sign that you're getting to the extremes of, but like it can still go up and back down again, like you can see here. So it's not the only thing you should look at. But these are spots when you're down in this area, 20 or below in the stochastics, that there's reversal potentials. So the way I sort of use it is if I'm looking at a spot that I would normally enter on and it's starting to incline, the stochastics were down and they start to incline, that's usually a good sign. But just because they're at the bottom or at the top doesn't mean, like here you can see the stochastic stayed up quite a bit as it went up, pulled back, but instantly came back up again. So the whole time it was pretty much in at a high level of stochastics here, 97. So it's not just the only indicator. Like as soon as you get to this high spot, you sell or anything like that. But it's usually, what I noticed is a couple of things is when the stochastics are down at the bottom, 15, 20, there's a reversal potential. And also what I noticed was when the price percent oscillator is down quite far from zero, like 1 or more, in that range, 0.8, 9, that usually you get a higher bounce back from that. So if you're down in this area and you do see a crossover, it is a weaker area, but usually that means that once you get to that point where you would buy with a higher low established, that usually you get quite a good bounce in those situations, but not all the time. But it's just something to consider. Here's another example where we came down to the 0.7, 0.8 period, and then we had a good reversal. So, all right, that's all I want to talk about. I look at the sectors, but I don't see a great, great scenarios here in things that I want to buy just because of the market situation. Of course, you could look at inverse ETFs. So if you look at SH, I don't really like, the S&P right now, just because it's right at that 50-day moving average. But there's NASDAQ ones, PSQ, things like that. So you have to look at these charts similar to the way you look at, any chart. But, these ones are a little tricky. You got downward trends in the 50 and the 200. You got to break through there. So you do have options to buy inverse ETFs, but when it's a volatile market, like one day it's up, it's down, or it's up half the day and then back down again, it's too risky to really jump in at this point, in my opinion. Hope that helps. If you want to get TC2000, check out a link below in the description. You can get a free trial or $25 off your purchase, and helps out my channel. It doesn't cost you anything, but I get a little bit of a commission, and I'm using this daily for running scans and alerts, and hopefully you're enjoying the videos that explain how I use it. Talk to you guys later.